The markets have finally broken toward the downside after a couple of days of consolidation. This rejection occurred from the 28,000 to 30,000 major yearly long resistance, as well as being triggered by the Federal Reserve announcing a 25 basis point hike, increasing the overall interest rates. This news, however, is not as it seems, and we're going to be discussing what this means for cryptocurrency going forward. We have a lot to talk about today, so let's get into it. Okay guys, welcome back to the channel. I hope you're all having a fantastic day today. We're here to discuss Bitcoin's price action, discuss where we expect Bitcoin to go next, the impact of that interest rate hike, and so much more. We'll talk about the broader markets, the traditional markets, the market data, and of course do a complete technical analysis on the smaller and higher time frames today. Before we get into it, smash that like button, hit the comment button, subscribe to the channel, click the subscribe button. We do daily videos for Bitcoin focusing on the facts, the data, and the objective realities of the charts. You can also find us on Telegram, guys. We do daily updates here, charts, videos, analysis, information, educational posts, news events, everything you need to stay up to date with the markets between our videos are posted in this channel. You can also get access to two things, which is of course the VIP channel, which will get access to the main VIP group. As you can see it over here, we have over 538 subscribers, and our group chat. So we've got access to 4 different subgroups. We have a general chat, a trading and chart chat, educational posts, news, altcoin videos, and so much more as well. So you get access to 2 exclusive chats when you get access to our VIP group. You can find all our trading track records here and so much more information in that pinned comment. Let's go ahead, guys, and get into the video, starting off with the market data. So currently for the month of March, we are up 17.93%. So obviously March has been quite a green month. Looking at our 24-hour volume, guys, 144 billion, up 30%. As expected, FOMC really does draw a lot of volatility and price action into the market, and we do generally see a lot more movement. We can see on the 24-hour liquidations, we had an 80% increase, over $240 million in liquidations in the past 24 hours. We haven't quite seen a 24-hour period with this many liquidations for quite some time, guys. What a volatile day. Looking at the 30-day period, 3.48, and the 60-day period, 3.09. That volatility is still on the rise and moving towards these liquidation data. We can see within that last 24-hour period, guys, we have seen the majority of liquidations actually come from late longs. And we've been saying for a very long time, for the last couple of days, you know, we had this rising wedge formation develop. Of course, the rising wedge formation did actually break down. It didn't really play out as expected, right? We did see a lot of consolidation a little bit sooner on that rising wedge, and again, this was mainly because the market was so resilient and stubborn. It didn't really want to move until FOMC, but we had FOMC come out, we saw that crash, we saw a correction, and all of these people who took these late longs, guys, all up above 28,000 in this major yearly long resistance, have now suffered the consequences of late longing. They've been experiencing liquidations. They've obviously got wrecked on those purchases, particularly if you are trading on higher leverage. And we have seen that flush out of these late longs. But again, guys, the trend is still healthy. This is nothing but a healthy correction. We'll discuss that in a second. Broader markets, guys, the DXY has absolutely plummeted. And again, you're probably wondering, why has the DXY dropped, guys, if we saw the interest rates increase? Well, once more, guys, the markets do not move on actual current risk. They move on perceived future risk. They move on perceived systematic risk. So what does that mean, and why has the DXY dropped? Well, to answer that, we need to go ahead and jump up to a little graph I drew before. And this is a little diagram of basically the correlation between interest rates and inflation, and then we can use this to describe how we can expect asset prices to move in the future. So really quickly, guys, DXY has been dropping, although interest rates have risen, and you're probably thinking, again, that is kind of contradictory, and it is contradictory, but it makes perfect sense. If we look at inflation, and we look at interest rates, inflation being the red line, interest rates being the black line, we can see that interest rates are generally lagging to inflation, meaning interest rates will not rise if inflation hasn't already risen, and interest rates will not fall unless inflation has already been falling. It's kind of what we've been seeing in the markets. So FOMC, guys, kind of just came out with a 25 hike. And what that suggests, it does suggest that we're not going to be increasing our interest rates, even though we saw inflation in the last period, the period before increase, and the period before, which we just had, kind of plateau across. We've seen that interest rates are going to continue this slow trajectory toward the downside, and that was confirmed by Jerome Powell saying that he doesn't intend to go negative in these interest rate rises. He doesn't intend to pivot this year, but he doesn't intend to increase interest rates in terms of the month-on-month increases are going to keep around 0.25 and potentially go zero for the rest of the year. And what this does, it sets a narrative that we are moving closer and closer and closer towards a pivot. And as we set that precedent in the market, we generally do see systematic risk, or at least the perceived systematic risk in the market drop, and a perceived systematic risk in the market drop, we do see asset prices rise, guys. So that is what we're seeing here. We have seen the DXY crash, even though technically the release was bearish, okay? It was technically a bearish piece of data, but if we zoom it out to the broader scale, we look at the overall implications of that data on a higher time frame in conjunction with all the other data and potential future data, because everything moves based on future projections. We can project that this data is a step in the right direction towards a pivot, and therefore the markets are going to react to this somewhat positively, hence why the DXYs dropped. The traditional markets didn't nearly drop as much as expected, and of course Bitcoin didn't nearly drop as much as we'd probably see if this news was incredibly bearish. So let's go ahead and jump into this. The DXY and Dow Jones, we saw the Dow Jones bounce from the 32,000 level. And look at this, perfect, absolutely perfect retest of 33,000. Since then, rejecting again, the rejection has not dropped it below the support level. The support level is still very much intact. Again, expecting a slow climb upwards, guys, unless the support level breaks. If the support level breaks, then we're going to expect a continuation downward. Moving on, S&P 500, guys, same story here, guys. We saw a rejection at the top level over here, pushed just over 4,000. We pushed all the way back down, sitting just under 4,000. Now we do have some kind of sketchy rising channel formation developing. Again, this is something to keep an eye on as it could break down and send us back lower. But again, we're not really expecting anything toward the downside, guys, unless these lows are swept and we come underneath this point, and then we're expecting continuation downwards. Until then, we do expect a slow grind toward the upside for the S&P 500. I wanted to briefly interrupt today's video to discuss my favorite exchange, Bitget. If you're looking for a safe, honest, reliable, and accurate exchange, look no further than Bitget. You can sign up by the link in the description to support the channel and get access to 3 exclusive perks. That being up to $5,005 in trading rewards, up to 15% discount on your trading fees, and exclusive access to our MegaWhale promotion campaigns that we run every few months. Alongside that, guys, Bitget is a non-KYC exchange, meaning you do not have to KYC. It is completely optional. Bitget also has a protection fund that secures user assets against external hacks and threats in the space. Alongside that, guys, Bitget offers up to 125x leverage on futures with extensive amount of trading pairs and liquidity on the market. I highly recommend signing up to Bitget. It is the exchange I've been using for over a year and a half now, including all of our members. If you're interested in signing up, trading there, and supporting the channel, you can do so with the link in the description. Thanks for listening. Okay, guys, let's go ahead and jump into Bitcoin. So Bitcoin has currently retested and rejected from the $28,000 to $30,000 major yearly long resistance. Now you're probably thinking, Whale, why is this important? Why is this so crucial? Well, the $28,000 to $30,000 resistance is going to be the higher time frame macro trigger for the initiation of a bull market. Therefore, a break and monthly candle close above 30,000 will be the exact point of which will determine the start of the bull market. Now, it doesn't mean the bull market is going to go parabolic from that point. Absolutely not. But it means, from a historical standpoint, every single time we close a monthly candle, guys, above the prior yearly low of the prior bull market, so there's red horizontal lines, that is when we go into a bull market phase. We never, ever, ever close a monthly candle back below it again. So we can assume if the same thing occurs this time, a monthly candle close of 30,000 will result in an extended uptrend that again could take some time to develop, but with certainty, according to prior data, we shouldn't close a monthly candle below $30,000 again, and thus triggering the start of a macro bull market. And that is why 28 to 30,000 is so crucial, guys. However, until we manage to break resistance, resistance should be considered resistance, guys. And if we invert the chart, you can see another example of this. We've come down, we've retested the neckline, okay? The neckline of these lows, and our prior low over here, again, is the yearly long resistance. Going back to our chart on the 3-day, guys, we can see we still do have some bearish divergences in play. We obviously have our bearish divergence on the RSI over here, decreasing RSI, increasing price action. We can see overall weakness starting to show up on the markets OB. Again, this is by no means a strong bearish divergence. As you can see, the bearish divergence has definitely started to weaken as time has gone along, and we can see in the MACD on the 3-day, we don't really have decreasing momentum yet. We still have this overall slow increase in positive momentum, but it's not really too strong. The difference is right now, we haven't seen a surge in positive momentum greater than the prior highs. So we do have rising momentum still, okay? We do have rising momentum, but the momentum hasn't been greater than what we have seen in these prior highs over here in comparison here, which is creating that divergence, signifying a general directional weakness. Now that doesn't mean we can't go upwards, because again, we do actually have some degree of strengthening momentum here, but it is showing us there is a degree of possibility that this will still be weak enough to bring us lower. We have now seen that rejection. The question is, was that rejection the healthy correction we're looking for, or are we going to see a slightly extended correction over the next couple of days, potentially taking us down to lower supports? We're going to answer that today. So let's go down to the daily chart and take a look at how it's looking. On the daily chart, guys, let's go ahead and delete some of these indicators. We can see now with a little bit more clarity what is going on with our momentum. On the daily chart, we can see in the MACD for the last 4 days, we have been seeing steadily decreasing momentum day in, day out, okay? We're not quite in that negative momentum territory yet. Again, looking at the MACD and the market side of B, we can see the momentum is still positive, right? We have green volume candles here, and the market OB is over that 0 point on the histogram, indicating we have positive momentum. We have positive momentum. What we can see if we zoom up on this green part here, we can see fading green momentum. This is signifying weakening positive momentum. And again, we can see our light blue line is converging towards our deep blue line. The distance is decreasing, signifying a potential flip incoming. Again, a red dot could print, and this could move toward the downside. Again, signifying weakening positive momentum. This is all happening while we are at resistance. However, higher time frame moving averages, higher time frame indicators are generally going to be more smoothed out. If we want to take a look at the overall direction and the next move, we do need to dive into the smaller time frame just a little bit. So let's go down to the 4-hour chart. On the 4-hour chart, guys, we can see some very interesting things. We can see, again, the overall momentum over here for the markets over B is very much positive, right? We have the markets over B indicating momentum is above that 0 point line. However, we are seeing a lot of signs of weakness and a lot of divergences occurring at this top part near that overbought territory. The MACD is steadily on the decline, meaning momentum has been dropping on the 4-hour chart since the 19th of March, which is around this point in time. We have seen a steep correction towards a 50 EMA on the chart over here, signifying that the overall trend, the current trend that we are in, is still upward on the higher time frames. We have an overall uptrend over here on the 4-hour chart. Again, we can confirm that using the Gaussian channel. We're above the Gaussian channel. We're above the 50 EMA on the 4-hour chart, signifying that anything greater than 4 hours, 4-hour, daily, 2-day, 3-day, 4-day, they're all still technically showing from a technical standpoint, we are in an uptrend challenging resistance, and therefore the correction should be considered healthy for now. Moving down to a hourly chart, guys, we can see a little bit of a different story. We have officially broken toward the downside, guys. I'm going to go ahead and move these down a little bit. Downside from the 50 EMA and the hourly, and of course broken underneath the Gaussian channel. this signifies a short-term flip in the overall trend. And if we go ahead and draw that trend line back in from that rising wedge, we can see a breakdown of that trend line, again signifying we have horizontal resistance, diagonal breakdown, a moving average breakdown to 50, and again the Gaussian channel signifying our overall shift in strength of a trend toward the downside. So we are still now technically in a smaller time frame downtrend. We have broken the uptrend on the smaller time frame, and if this continues downwards, this could bleed into the higher time frames. I would be concerned for a continued correction if we lose the 50 EMA and push into the 4-hour Gaussian channel. If that occurs, that is when I'd be expecting a move towards 25,000 for support. Until that happens, guys, we could potentially be seeing some sort of rebounds occur within this current support range. Let's go down to an even smaller time frame. Let's go down to 30 minutes. On the 30-minute chart, let's take a look. So obviously, having quite a steep correction, guys, within the last 12 hours, the volatility is going to be there. We are going to see moving averages show a lot of volatility, and this price action is not going to be kind of averaged out yet or smoothed in. So we do have these large gaps between our moving averages and price, which again represents overall volatility. We can see the MACD has crossed over, but very much still in the negative territory. We can see the market side of B did not print an oversold indicator, but it is starting to slowly pick towards upside, but very, very slowly. We have a very, very slow decrease in negative momentum, so positive momentum's coming back, but incredibly slowly. If we take a look at our current market structure on the smaller time frame, we can take a look at this on the 15-minute chart and draw in some structure. So we currently have a nice strong neckline of resistance here. Again, the 50 EMA is coming down. I wouldn't expect any sort of continuation upwards until that neckline breaks on the smaller time frame, bringing up our VRPV to see where our supports are and our resistances are on the smaller time frame. Could be pretty beneficial. So let's go ahead and do that. We can see we do have a pretty steady increase in resistance as we move towards the upside, and we have a pretty steady decrease in support as we move toward the downside to retest again this 50 EMA on the 4-hour chart around its range. We do expect a continuation, a very slight continuation to occur as we push upwards through this resistance, but we do not see any sort of higher time frame continuation occurring until this 28,000 to 28,100 POC level breaks. Therefore, a logical explanation over the next short term could be a rally towards upside and another rejection, guys. We do have a slight uptrending support developing over here, which goes ahead and tells us we have a ascending channel formation. The measured move from an ascending triangle, formation is going to be the distance between the first retest and the second retest. That could take us potentially to 28,000, confirming the short-term impulse up to 28,000. Again, guys, unless we get a break above 28,100, we do not see any sort of continuations back within this range. So do not expect the 28,100 resistance or the 30,000 resistance zone to be retested until we break back above 28,000, particularly that 28,100 peak on the VRPV. Until then, the trend is starting to lose strength and is generally dropping toward the downside, particularly on those smaller time frames, as the smaller time frame moving averages are starting to signal a decreasing momentum and a loss of their structural supports and technical supports. So, very quick summary. Macro rejection from the yearly long resistance, triggered by FOMC. The higher time frames are looking quite bullish. If we look at the moving averages on the weekly, we are looking quite bullish. However, a bull market is not going to initiate until we get a monthly close above 30,000. This is still going to be an absolutely crucial level of resistance on the chart to flip the overall trend from reversing to macro uptrend. Currently on the smaller time frame, we are seeing divergences playing out on the 3-hour, on the 3-day, the 2-day, the 1-day. These divergences are seeping now into the small time price action, as we see that anything up to around 2 hours starting to lose its trend. We're seeing breakdowns of the Gaussian channel. We're seeing breakdowns of trend lines. We're seeing loss of important moving averages. The trend, particularly the downtrend on the smaller time frame from the rejection 20K, 28K, is starting to build up some volume, build up some momentum, and build up some velocity. However, on the higher time frames, such as a 4-hour, such as a 5-hour, such as a 6-hour, we do have a decent amount of support currently. This support is indicating a 50 EMA bounce, is indicating Gaussian channel, and is representing that the overall trend we're still in and the medium to high time frames is still intact, indicating that this rejection was not strong enough to be something of massive concern, yet it is just a healthy correction from a major resistance. Watch the smaller time frame to see what happens over coming days to see how it plays out.